The business model behind self-storage. Before you copy a business model from a thumbnail, understand how self-storage works in practice. Money Machines maps the full economics. Illustrative estimates only, not financial, legal, tax, or investment advice. Self-storage facility economics revolve around land or building acquisition, and rate components, useful for benchmarking a local market's health. Those small independent facilities without a national brand and app ecosystem typically convert new tenant leads at lower rates than these REIT platforms. Compare gross revenue to net cash flow, they are not the same. Startup cost range, illustrative $500,000 to $8 million plus depending on ground-up build versus conversion. This is capital-intensive, land, construction, or conversion of an existing building commonly estimated at $2 million to $8 million plus for a mid-size facility, far less if converting warehouse space. Ongoing costs include property tax, insurance, minimal staffing, often one part-time or remote manager, security systems, and marketing. Reaching stabilized occupancy, often 80% plus, commonly takes 2 to 4 years from opening, a long capital lockup before strong cash flow arrives. Margin pressure, high operating margins once stabilized, 50 to 70%, thin during lease-up. Owner labor is frequently the largest hidden cost, value your time at a realistic hourly rate. Ground-up construction commonly runs $40 to $70 per square foot depending on region and climate control ratio, before land cost, which varies enormously by market and is often the single biggest cost variable. Permitting and zoning approval can add months to years to a project timeline in markets where storage development faces community pushback, a cost most feasibility studies underweight. Modern facilities increasingly operate unmanned, using app-based rentals, keypad or Bluetooth gate access, and remote video monitoring instead of an on-site manager. This can cut labor to near zero, but requires meaningful upfront capital in access control and camera systems, commonly $20,000 to $100,000 depending on facility size, plus ongoing software subscription fees that scale with unit count. Property tax reassessment after construction completion is a commonly underestimated cost that hits 1 to 2 years after opening, once the county assesses the finished facility at its new, higher value rather than the pre-development land value used during underwriting. Operators who modeled taxes on the land-only assessment are frequently surprised by a meaningfully higher bill during the already thin lease-up years. Construction financing for storage typically uses commercial construction loans or, for smaller projects, SBA 504 financing. Because lease-up to stabilized occupancy commonly takes 2 to 4 years, variable-rate construction debt carries real interest rate risk. A project underwritten at one rate environment can face materially different debt service by the time it stabilizes. Overbuilding in saturated metro submarkets compresses both rents and occupancy. New developers underestimate lease-up time, assuming near-instant occupancy. Poor site selection, weak highway visibility, low population density, is difficult to fix after construction is complete. Content built around REIT cash flow figures glosses over the multi-year, capital-heavy lease-up phase most new facilities actually face. Key failure points: market oversaturation, slow lease-up, poor site selection, underpriced initial rent. Hype content optimizes for clicks, operators optimize for contribution margin and cash runway. New operators frequently model revenue off REIT-reported stabilized cap rates and same-store growth, applying those mature portfolio numbers to a facility that hasn't yet filled a single unit. The multi-year lease-up curve is an S-shape, not a straight line. Early months post-opening are often the weakest of the facility's life, precisely when debt service is highest relative to revenue. Zoning and permitting risk has grown as storage development draws more community opposition in land-constrained, higher-value markets. Neighbors and planning boards increasingly view large metal box facilities as a poor use of scarce developable land. Projects can be delayed or rejected after significant pre-development spend on land options, engineering, and legal fees. Building the wrong unit mix for the local market is a quiet, expensive mistake. Developers sometimes overbuild large units because they're simpler to construct per square foot, only to find actual local demand skews towards small units. Retrofitting unit walls after construction is far more expensive than getting the mix right in the design phase. This is a poor fit for beginners without meaningful capital or real estate development experience. The combination of multi-year lease-up, construction risk, and financing complexity rewards operators who can absorb a slow, capital-locked ramp. It is a reasonable fit for capitalized investors comfortable with real estate development timelines, not a side hustle entry point. Verdict on self-storage: poor for beginners without real estate capital, better suited to experienced investors/operators. Startup cost: very high scalability, high automation, high once stabilized risk, medium-high beginner. Poor verdict: strong asset class for capitalized investors, not a beginner side hustle. Do the spreadsheet for your market. Run a small test before scaling. Self-storage is a legitimate, high-margin real estate asset class once stabilized, but buy land, add doors, collect rent understates the multi-year development and lease-up gauntlet nearly every new facility goes through before reaching that stabilized state. Before committing capital, run a market feasibility study using REIT same-store data and local competitor occupancy as benchmarks, and stress test the pro forma assuming a slower lease-up and higher construction cost than your base case. Most storage failures are underwriting failures, not operating failures. Subscribe to Money Machines for more hype versus reality breakdowns. Educational content only. Illustrative estimates. Not financial, legal, tax, or investment advice.